Good afternoon and welcome to our focused discussion on the proposed amendments to the taxation laws. This is an appropriate time to discuss these amendments since it follows the draft bill that was published and the public participation that was held, and then the recent response document that was issued by National Treasury, but even more so after the bill was tabled yesterday by the Minister of Finance during the midterm budget. So this session will not cover all the amendments, but we would focus on the most relevant and impactful changes. My colleagues and I will be discussing the technical issues and examine how we deal with these developments. Should you have any questions, we would really like to hear from you. So please put your question in the chat box, and if time permits, we'll deal with it at the end of the session, or we will be reverting to you after the session. Just broadly, our agenda for today, we will be discussing the business tax amendments first, then talking about the VAT amendments, and also just hearing what Charles has got to say about the VAT modernization project. And then we will end off with the changes to the TAA, specifically focusing on the bona fide inadvertent error changes. So let's get down to business. Business tax first. Yes, this was an interesting legislative cycle. We all received the draft bill, and then we saw the changes, or very material changes to Section 8E, and then shortly thereafter, those changes were withdrawn. But I'm going to hand over to Magda just to give us an update on where we are with those 8E changes, as well as just discussing 8EA, together with Section 41 and the impact on collective investment schemes. Magda?
Thank you, Christel. Good afternoon, everyone. Yeah, there certainly have been some radical proposals this year. Fortunately, there's also some good news. Christel mentioned Section 8E. So as you know, Section 8E taxes dividends on preference shares to the extent that the preference shares or the shares are redeemable within 3 years of date of issuance, or the holder has a right to require a redemption within 3 years. And then on 16 August, the draft Taxation Laws Amendment Bill proposed to amend Section 8E in such a way that any share or financial instrument which is classified as a financial liability in the annual financial statements of the issuer in accordance with IFRS would fall within the provisions of Section 8E. So they removed the 3-year requirement. And SARS noted that the intention behind this amendment or proposed amendment was to disregard the legal form and to look at the substance of the shares. So this was a far-reaching proposal, and there was no prior warning, and the proposed change it had caught the industry completely off guard, and it would have effectively been retroactive, as it would have impacted on all existing preference shares in issuance. So less than a month later, on 3 September, a media statement was released containing the good news that the proposal will be retracted in order to avoid the current negative impact on the funding landscape. And I can confirm that it isn't in the bill, so all good. But it's not the end of the road, because the press release also stated that future proposals on structural changes to the taxation of hybrid equity instruments will follow a consultative process with stakeholders to identify a balanced approach. So they'll take into account what SARS wants and what the industry, their concerns. So it means that we need to keep our eyes open, because there could be a budget announcement that there will be changes to Section 8E, and there could be draft legislation following next year. So let's see what happens. A further change that will be promulgated is the one to Section 8EA, and this section taxes dividends on third-party backed instruments. So that's where the holder has a right, or an enforcement right, against someone other than the issuer. And the amendment is to tax dividends if the shares constitute third-party backed shares in the current year or in any previous year of assessment. So you go back and you look at right to the issuance of the preference shares, if there was an enforcement right and if they constituted third-party backed shares. If if you can tick that box, then the dividends will be taxed. And the reason they've given is to ensure that parties cannot contractually waive the enforcement right in a specific year in which the dividends are declared and then reinstated in the next year. So the effective date of this change is the 1st of January 2026. It will apply to years of assessments commencing on or after this date. But because you're looking back to the previous years, is effective already, and it will affect current arrangements. I'm now going to move on and quickly deal with the amendments which impact on collective investment schemes. And you will recall those radical proposals a year ago in November in the discussion document dealing with the taxation of collective investment schemes. This has resulted in the draft bill containing proposals which take away the ability to transfer assets on a rollover basis in terms of Section 42 of the Act to a collective investment scheme. But it also took away the ability of collective investment schemes to amalgamate and merge. Now, fortunately, they've amended the provisions, so collective investment schemes will continue to be able to amalgamate and merge with each other on a rollover or tax-free basis in terms of Section 44. But they are taking away the ability to transfer assets to a collective investment scheme on an asset for share basis, in other words, in exchange for participatory interests. But this change will only be effective from the 1st of January 2027. So there's a little bit more than a year to still transfer assets into collective investment schemes, and you can still get rulings to that in that regard as well. The other concession, which is a really nice one, is in addition to these changes, from the 1st of January 2027, you can transfer shares to a collective investment scheme, and there's no STT for the collective investment scheme on that transfer. So that resulted from the comments that were provided. I think this is a great one. And then the last change affecting collective investment schemes is currently a collective investment scheme can make a capital distribution, and the recipient is not taxed on the receipt of that distribution, as long as it doesn't result in the disposal of the participatory interest. But they're taking away the ability to distribute capital gains and for the receipt to be tax-free in future. So from the 1st of March 2026, the receipt or the accrual of a capital gain from a collective investment scheme or capital distribution will be regarded as a capital gain in the hands of the recipient. So it would be subject to capital gains tax at that point, but because it's treated as a capital gain, you can still set it off against capital losses. And that is it from my side. I'm going to hand back over to you, Christel.
Thanks, Magda. Yeah, I think this year is quite evidence of what you've mentioned, is how important public participation in these consultation sessions with National Treasury is once they've issued the draft. And we've seen it with the amendments you spoke about, and we'll see it throughout today. Next, I'm going to hand over to Ntabeleng, that's going to deal with amendments that affect mainly businesses. Ntabeleng will take us through the balance of the rollover relief amendments, dealing specifically with asset for shares, enlisted shares, clarifying the ordering of the set-off of balance of assessed loss and certain deductions. Also, just quickly dealing with the clarification of the determination of contributed tax capital. And then lastly, she will be dealing with Section 64E with your deemed dividends and the latest amendments there. Thanks, Ntabeleng.
Thanks, Christel. Good afternoon, everybody. So now I think we're moving on from the more controversial proposed amendments or amendments to things that might be more welcome by the taxpayers. First, we'll start with Section 18 Cap A, which deals with donations and the deduction of donations, of qualifying donations from taxable income. Section 18A has been amended to clarify that the 10% that can be deducted from taxable income must be determined before the setting off of assessed losses determined in terms of Section 21A. And I think that's a welcome clarification, just, to give clarity to taxpayers on how to order their affairs in that regard. The second positive development is to Section 8G of the Act, which deals with contributed tax capital. It's an anti-avoidance section that was introduced in 2017 to avoid or to prevent the artificial creation of contributed tax capital by non-resident shareholders. And what National Treasury identified was non-resident shareholders who had shares in a South African OpCo would then interpose a South African HoldCo via an asset for share arrangement, where they would then get issued shares in the HoldCo, and they would then dispose of the shares in the SA OpCo as consideration, and then the contributed tax capital in the HoldCo would be equal to the market value of the shares in the OpCo. So they'd get a step up in their contributed tax capital without actually changing their shareholding in any substantial way. And this was done so that any money extracted could be returned as a return of capital instead of a dividend that would be subject to dividends withholding tax. So that's been in place for a while, since 2017. And National Treasury has now said they've identified instances where there's legitimate capital contributions by non-resident shareholders, where the HoldCo would then utilize that money to buy the existing or issued share capital of the OpCo from unconnected third parties, and that falls outside of the mischief of 8G, and that will therefore then be excluded. So where they use the money from the non-resident shareholders to buy issued share capital from third parties, then they fall outside of the net of 8G. So I think that's a welcome clarification as well. The third amendment that's quite relevant is Section 42, asset for share transactions, in respect of the disposal of shares in listed companies. Now, generally, to qualify for Section 42 tax rollover relief, the disposing person and the acquirer of the asset must both retain the same tax character of the asset. So, for instance, if the person disposing of an asset holds it as trading stock, then the acquirer must also acquire it as trading stock, and the same applies where it's held as a capital asset. Now, the one carve-out for that is the proviso to the definition, which applies to listed shares. So the proviso says that if you are having a disposer that's disposing of shares in a listed company, then the acquirer does not have to acquire it as a trading stock or capital assets, as it was that tax character in the disposing person's hands. And essentially, it just has the effect that the acquirer is deemed to basically acquire it for cash at market value, and they get a step up in the base cost. Now, National Treasury has said, well, since 2010, when the section was introduced, the policy intent was always that it would only apply, so the provisos only apply in instances where the person who's acquiring the shares in the listed company will have a substantial shareholding after the transaction. So either at least 35%, or if they don't hold 35% in the listed company afterwards, 25% if no one else holds more of the shares in the listed company. And the second was, it was only intended to apply to disposals by minority shareholders in the listed companies. And that would be people that hold 20% or less, so less than 20% of the shares in the listed company. That proviso would then apply to them. The legislation didn't specifically say or explicitly provide for the 20% threshold, and that's what the amendment is meant to address now. So it's a clarification according to National Treasury, but just something to keep in mind when you are doing asset for share transactions going forward. You will need to see what the percentage of the shareholding is of the person disposing of those listed shares to see if they qualify for the rollover relief. And I think the final one, which is also not controversial, I wouldn't think, is the amendment to 64E and the deemed dividends. So 64E4 provides that if there is a loan advanced by a company to its shareholder, which is not a company and is a resident, so a trust or a natural person, then that would be, there'd be a deemed dividend in specie in the hands of that shareholder. And the clarification or the amendment just adds the words direct or indirect shareholding. So now it just applies to subsidiaries. So you can't get around it by getting a subsidiary of a company to then advance an interest-free loan to the shareholders of its holding company to get around that. But I think that's a clarification, and it shouldn't be controversial at all. So that's what's happening in the corporate tax space. Lots of clarifications and sort of policy intent, clarifications from National Treasury, but nothing that should raise any eyebrows or cause anybody to lose any sleep. So that's it from me. Thanks, Christelle.
Thanks, Ntabeling. Yeah, it's quite clear that some things take a while to be amended. If you think about the group rollover relief coming in 2010, and only now they're amending those sections. So it took a while, but it's here. So thank you. I'll be discussing the amendments that was tabled to the interest limitation rules in section 23M. So just a quick recap, the interest limitation rules in 23M is designed to only apply to interest in respect of debt where the debtor and creditor is in a controlling relationship, and that interest is not being fully taxed in South Africa. So that's the basic of 23M. In 2022, significant changes were made to 23M, which one of them was the amendment to the definition of interest. It was expanded to be wider than 24J. For example, it included forex gains and losses. So it was, and interest on finance leases, etc. So it was expanded quite a lot. According to National Treasury at that time, and they reinforced this policy in the response document now, is that these changes were made to reduce the opportunity to disguise interest as other types of payments, economically equivalent to interest. So that would enable circumvention of the rules. So that was the reason for this expanded definition of interest for 23M purposes. Now, the adjusted taxable income calculation, which is effectively your driving number when you want to calculate how much interest will be allowed after 23M applies. So to calculate your adjusted taxable income, you effectively add back all interest deductions and you deduct all interest income to get to your so-called EBITDA. Now, if you think about this calculation at the moment, it refers to interest, which is the defined term of interest, and that would be any interest. It would even include third-party interest. And that was never the policy intent. As I mentioned to you, it was really just interest between a debtor and creditor in a controlling relationship, and that interest wasn't taxed in South Africa. So, and then further on, by this expanded definition of the interest in 23M, effectively things like all forex differences would be also included in that adjustable taxable income calculation, even if that forex difference had no underlying debt. So submissions were made to National Treasury. This was also discussed as part of the Annexure C consultations last year. And most of the submissions were in the line of delete the definition of interest as per 23M and revert back to 24J interest. But as I mentioned before, National Treasury insists to have the definition of interest as it is at the moment to ensure that the circumvention of the rules does not take place. So, but they did listen, and they made certain amendments to Section 23M to accommodate these problems regarding the expanded definition of interest. There were three groups of amendments they made, or what they tabled. The first group of amendments have the effect that the interest expense and interest income adjustments to arrive at your adjustable taxable income is limited to interest as contemplated in 24J. So now when you calculate your adjusted taxable income, it will only look at interest per Section 24J. So your other elements of interest like forex gains and losses will now not be used in that calculation. So for example, there is no need to include a forex difference in respect of a loan from an independent bank into this calculation, which is based on the current wording the case. Also, any amounts incurred or accrued under an interest rate agreement for Section 24K1 purposes, where there's no controlling relationship, will also not be included. And then any finance cost element in a finance lease, if there's no controlling relationship, will also not now be included in this calculation. So they simplified that. The second group of amendments, also to clear up these comments that I mentioned, was to make it clear that a forex difference will only be tested for Section 23N purposes to see if it will be limited if the exchange item is linked to a debt for which interest payments are subject to 23M. So if a taxpayer incurs a forex loss due to trade transactions with a creditor that's in a controlling relationship, but there's no underlying debt, then 23M will not apply. And I think this is a welcome change. However, if the forex loss is linked to a debt with a person where there's a controlling relationship, such forex loss will be subject to the interest limitation rules, and that's regardless of whether that there's an accrual for that creditor or not. Then the last group of amendments in Section 23M expands the carve-out for the back-to-back lending. This is a welcome change. The amendment has the effect of a full carve-out for direct lending and indirect lending from a bank if the interest is acceptable. And just to give you a reminder, interest will be acceptable if the interest rate is less than the official interest rate plus 100 basis points. The carve-out only includes interest contemplated in 24J. And as I mentioned before, to this whole situation about forex and the added elements of interest in this specific definition, any related forex differences, etc., in respect of that debt will also be carved out of Section 23M if it falls within this acceptable amount of interest. And of course, it is a back-to-back that is a qualifying back-to-back. So welcome changes to 23M. I think I get the sense that every year they carve 23M more and more to be commercial. And we should just, if there's anything, we should keep on making submissions. These amendments that I just mentioned will take effect for years of assessment commencing on or after 1 January 2026. And just while I'm on the topic of interest limitation rules, just a reminder, as from 1 January 2027, so we still have another year and a bit, the amendments to 23N will apply. We haven't seen them in a while, so that's why I just thought I'd bring it up. 23N deals with your debt incurred in respect of reorganization and acquisition transactions. And the changes effectively does away with the formula on how to determine how much interest will be disallowed, which was based on the current repo rate. That will be now replaced with a fixed amount of 0.3 as a factor that will be multiplied with your adjusted taxable income. So that's on 23M, and a little bit of a reminder on 23N. While we're busy with financial instruments, we'll move on to consider the amendments that will take effect on financial institutions specifically and products. Stefan, I will hand over to you just to take us through these amendments and also just touch on 11G that is coming in with regard to back-to-back funding. Stefan?
Thank you, Christelle. Good afternoon, everyone. The TLAB includes an interesting amendment to Section 24JB to tax some of the dividend income of covered persons like banks and stockbrokers. Now, as you know, Section 24JB aligns the tax and accounting treatment of certain transactions of covered persons, and they have to recognize fair value movements on financial assets and liabilities in their taxable income. The section overrides normal tax principles, such as the dividend exemption for corporates. But 24JB does have its own tailored exclusion or carve-out for amounts relating to dividends that are received or payable by a covered person. So those dividends are kept outside the tax net. Now, the TLAB proposal switches off the carve-out and it makes local or foreign dividends on a share taxable in terms of 24JB if the share meets two requirements. The first one is that the share must be measured at fair value in profit or loss in terms of IFRS 9. And the second is that the share must serve as a hedge for a financial asset or liability, which is also measured at fair value in profit or loss. The type of transaction that seems to have prompted the proposed amendment is where a covered person holds shares to hedge an equity-linked note. Now, an increase in the equity-linked note liability is deductible by such a taxpayer, but the dividend income which hedges part of that liability was excluded from income. So the TLAB aims to eliminate the mismatch by making the dividend income taxable. One may ask why it's necessary to amend 24JB, because mismatches between dividend income and related expenses are already prevented by Section 10(1)K for local dividends and by Section 10 Cap B for foreign dividends. So in terms of 10(1)K, dividends received or accrued are not exempt where there's offsetting expenditure that's determined by reference to such a dividend. But in fact, Section 10(1)K does not go far enough to catch all dividend income, for instance, in our equity-linked note example. And the reason is that 10(1)K applies to dividends that have been received or accrued for tax purposes. But for accounting purposes, dividends may accrue before they are declared or paid. You know, for example, accruals of roll-up dividends that have not yet been declared. So the amendment to 24JB will catch those dividends, notwithstanding that they've not yet been received or declared. A further question relating to this amendment is, of course, what is a hedge? Now, the first version of the TLAB referred to a hedging instrument, but the latest version, which was released yesterday, refers to a hedge. The response from Treasury and SARS to comments on the TLAB makes it clear that they do not intend to define what a hedge is. So the word has its general meaning, which of course is not the same as a hedging instrument for accounting purposes. And this may seem surprising. I mean, after all, the purpose of 24JB is to adopt accounting treatment for tax purposes. And it does create uncertainty to rely on the general meaning of a word such as hedge, which could have many different meanings. But moving away from the accounting definitions, I think, does have merit. For example, for accounting purposes, a hedge must typically be designated as such at the inception of the hedging relationship. And that flexibility is useful for accounting purposes, but after all, tax treatment should be consistent and predictable. And it should not be subject to designation or non-designation of transactions at the option of the taxpayer. So I think relying on the general meaning of a hedge instead of the accounting treatment may make sense after all. Apart from the uncertainty about the meaning of a hedge, the methodology to apply the new rule is not clear. In contrast with Section 10(1)K, the 24JB amendment does not subject dividend income to tax to the extent that dividend-related expenditure is deductible. Instead, all amounts in respect of a dividend on a share hedge fall within 24JB and in terms of the proposal. So that means that the taxable dividend income may exceed the hedged expenditure, for example, when it is an imperfect hedge. So the practical application of the amendment will not be straightforward. Finally, On 24JB, one may ask whether all dividend income of a covered person will now be taxable. Under the accounting rules, dividends on non-trading equity investments are recognized in other comprehensive income and not in profit or loss. And since the amendment only applies to dividends on shares measured at fair value and profit or loss, dividends on those non-trading shares will remain excluded from 24JB. And the proposal will be effective from years of assessment from January 1 next year. The next amendment I want to touch on relates to so-called FLAC instruments. The acronym stands for First Loss After Capital. And those are instruments which are debt instruments, and they are governed by banking regulations, and they're designed to reduce the cost of a bailout. So if a bank's capital has been depleted, the FLAC instruments may then absorb losses by becoming contingent or converting to equity. The hybrid debt rules of sections 8F and 8FA apply to debt instruments with equity-like features, and the interest expense on such debt is reclassified as non-deductible dividends. So the TLAB now proposes that FLAC instruments will be excluded from sections 8F and 8FA, and that will prevent interest deductions on such instruments being disallowed. So it clearly is a very welcome amendment. It is also effective from January 1 next year. And the final amendment I just want to deal with is section 11 cap G. That is a section that grants a deduction for interest expenditure that is not incurred in the carrying on of a trade. Now, the TLAB provides that a deduction under 11G will not be disallowed if the interest represents a domestic or a private expense. And of course, normally, such expenses are non-deductible in terms of 23 small b, but 11G is not subject to that requirement, fortunately. Now, historically, Practice Note 31 disregarded the trade requirement for expenditure incurred in the production of interest. And Section 11G, which is, of course, the legislative successor of Practice Note 31, will come into effect from January 1 next year, which is the same date that Practice Note 31 will be withdrawn. So just bear in mind that we have a new dispensation from January 1 in terms of 11G. Christelle, those are the amendments on my list, so back to you.
Thank you, Stefan. So next up, we've got Nikki. Nikki, will you please take us through the material amendments that affect taxpayers with any international links? Nikki?
Oh, thanks, Christelle. Good afternoon, everyone. I'm going to chat you through the international tax-related amendments. The first one is an amendment to the definition of an equity share. As you know, that definition currently refers to any share in a company, excluding any share that neither as respects dividends nor as respects returns of capital carries any right to participate in a specified amount in a distribution. And as you all know, this term is used frequently throughout the Act. So what's stated in the explanatory memorandum is that shares in a foreign company appear to be excluded from this definition. And the proposed amendment or the amendment now tests the existence of an equity share with reference to a foreign company by incorporating a reference to foreign dividends and foreign returns of capital. So I think it's interesting. I mean, it does tidy things up, but the term equity share is used in the Act with reference to foreign companies, for example, under the corporate rules. But I think this just sort of neatens it up and clarifies that you can have a foreign company can have an equity share. And this change will come into operation on the 1st of January 2026. Then the next amendment is the interaction of Section 9D with Section 9 capital H. So as you know, Section 9D contains the controlled foreign company rules of this, or the CFC rules, which effectively attributes an amount equal to the net income of a CFC to its South African resident shareholders. The net income amount is determined as if the CFC is a taxpayer in terms of our Act, and also as if it is a resident for purposes of certain sections. So there are various exemptions in the ambit of the CFC rules, and one of those exemptions is the so-called high tax exemption. So in essence, what this exemption does is it says you must treat the CFC as if hypothetically it were a South African tax resident, and you then determine how much South African tax would have been paid if the CFC was a resident. And then you take the actual foreign taxes suffered by the CFC, and if those foreign taxes constitutes at least 67.5% of the normal hypothetical tax you've determined, then the net income of the CFC is deemed to be null. So then on the other hand, what Section 9H does is that's the provision that deals with the so-called exit charge, where amongst others a CFC ceases to be a CFC. And what then happens is the CFC is deemed to have disposed of all its assets at market value. And the impact then is that if a capital gain is realized on the deemed disposal of the assets of the CFC, then that amount will be taken into account in the net income of the CFC, and it will be taxed in the resident's hands in accordance with its participation rights. But what the explanatory memorandum says is it says that the current wording of the high tax exemption is not sufficient to take into account this exit charge in relation to a CFC. In particular, because when testing the high tax exemption, the exit charge in 9H can be disregarded, since for purposes of that tax calculation from a South African perspective I've just mentioned, because you're treating the CFC as a hypothetical resident, it cannot cease to be a CFC, so you can't read that in, which means that you completely ignore the deemed sort of the exit charge, which means that if the CFC just qualifies for the high tax exemption, then that whole deemed disposal exit charge is disregarded. So how they propose to deal with this is that the high tax exemption will be amended and a proviso will be added which says that the taxable income that you determine in terms of this hypothetical calculation must be increased by that exit charge that you've determined in terms of Section 9H. And that then means effectively that I think in that scenario, if there are significant exit or capital gains that are realized on the exit, that the CFC is unlikely to qualify for the high tax exemption because, of course, in the foreign jurisdiction, that is not taken into account at all. So I think, you know, you would then have to so I think what's interesting about the way that it's been done or introduced or fixed is that in a normal year, that CFC might have qualified for the high tax exemption, but if it now in a year ceases to be a resident, then that means that all the normal income is disqualified from qualifying for the high tax exemption. And it might not be the end of the world because you could qualify for one of the other exemptions like the FBE exemption, and also that the resident can claim credits for any actual foreign taxes suffered against its income in South Africa. But I think we often find that it's more beneficial to qualify for the high tax than to claim the actual credit for the foreign taxes suffered. So that's just something to keep in mind. And this amendment comes into operation on 31 December 2025 in respect of foreign tax years of CFCs ending on or after that date. So it's already applicable. Then Section 24I of the Act is the last provision that I just want to touch on. So this is the provision that taxes realized and unrealized exchange gains and losses in respect of exchange items such as loans. And in 24I, there's 24I10 capital A, which provides for the deferral of foreign exchange gains and losses on specific exchange items, notably long-term debt instruments between connected persons or members of the same group of companies. And this provision effectively applies where the loan is not classified as a current asset or current liability for financial reporting purposes under IFRS. And the principle effectively of 24I10 is that those gains and losses are deferred until the loan, for example, is repaid when it's realized, and then you sort of catch the whole full gain or loss over the period. But it seems that there's been they've caught that there's some manipulation of this provision, and they've sort of slightly amended the wording to now say that where an exchange item such as a loan is recognized as a non-current asset or liability for financial reporting purposes, 24I10 will not apply. So you will not have the deferral. And it's also proposed that the deferred exchange differences are triggered where a portion of an instrument no longer qualifies for the deferral. I think, for example, if the accounting classification changes, then that difference is calculated, but at least with reference only to the end of the prior year of assessment. So it doesn't go back to the period where it's still you sort of qualified for the deferral. And this amendment only comes into effect 1 January 2026, and in respective years of assessment commencing on or after that date. So there is time to consider what the impact of that is. And thanks, Christelle. That's everything from me.
Thank you, Nikki. Charles, we're going to hand over to you now to discuss the main VAT amendments. And also, if you can just highlight for us what's happening around the VAT modernization project. Thanks, Charles.
Thank you, Christelle, and good afternoon, everybody. There is, in fact, only one significant VAT amendment that affects all businesses, and that is the VAT modernization project. So this is sort of the next step as far as that's concerned, and the first amendment that have been introduced as far as that's concerned. I mean, it was originally announced in 2023. I know that there's a discussion paper on the way that hopefully will be available early in December. It should have been published already. But what they've done this time round is they've introduced particular definitions into the VAT Act, dealing with sort of e-documents, e-invoices, e-debit notes, e-credit notes, and I mean e-reporting, and then also a definition of an interoperability framework. And this is to make it possible to share information between different vendors and with SARS in the circumstances as well. So they've given a little bit more insight in terms of the direction that this is heading in. I mean, they have disclosed their design principles, which is best service is no service, and that there is a good history of voluntary compliance, or at least the intention of voluntary compliance. So the intention is to build a system that replaces very much the manual paper-based system that is pretty much inefficient from a compliance perspective and has a high risk of errors. And I mean, the intention would be pretty much based on the European system that is being implemented at the moment, that it will be a decentralized system, so that there will be an exchange of information. People can use their existing service providers in respect of e-invoicing, for example, and that will then facilitate clearance between, I mean, vendors, so, both the supplier and the recipient, and the information to SARS in a real-time or near real-time basis. I mean, the intention is not necessary to speed up the process, so it will still be really big businesses that will initially have to comply with this. And besides the definitions that have now been introduced, they've also, created the opportunity for the minister to publish regulations on exactly how that would operate in the circumstances. So that's, I mean, quite a significant change, but still a long-term change. I think the next bit that we will see is sort of I think there's a white paper that is being published about SARS's IT process, and then a component of that is the VAT modernization program that will give us a lot more detail, both from a timeline perspective and in fact who it impacts. So this is significant, but not anything that we need to be terribly concerned about immediately. Then, I mean, there were a number of other sort of industry-specific amendments that were introduced, and I won't go into too much detail as far as that's concerned. Sort of following the Capitec case, and when you give insurance cover away for free, whether that is really insurance or not. So there is now a requirement that there must be a premium that must be levied in the circumstances. It doesn't define how big or small that premium needs to be. So it's trying to, I think, legislate out of what the Constitutional Court said in the circumstances, and I'm concerned that the wording makes it worse than it was previously. I mean, in the mining industry, there has sort of replacing the old Section 72 rulings in respect of the refiners and the commingling that happens. Gold was always included in that in terms of the documentation for export. They've added silver in to that as well. I think that was just an oversight initially. There's been an amendment applicable on foreign airtime vouchers. So whether you have to charge VAT in circumstances when you sell airtime that can only be used in Zimbabwe or in the Middle East, for example. So I think there's been a lot of confusion about that. So this is a clarification as far as that's concerned. They've introduced something in sort of testing services or clinical trial space, sort of research services. So pretty much in the medical space and also in the pathological space, for example, when you provide services to non-residents or do clinical trials for non-residents, they can in fact now be zero rated. I mean, this is quite significant in terms of the funding perspective and what's happened in the US in terms of that funding that has disappeared. So we became a very expensive place to do clinical trials, for example, simply because there was a VAT cost on that. So this amendment comes into effect in April next year. And then also, within sort of the platform space, the e-commerce space, the imports of low-value goods, there's always been a 500 Rand exemption where there was no VAT applicable in the circumstances, with a number of foreign platforms now also advertising in South Africa and selling them at very, very low cost. There are sort of quite significant economic distortions between foreign and local supplies as far as that's concerned. So they've deleted the 500 Rand low value goods. This is also the area where it's probably globally the most VAT fraud that is happening at the moment. So we are a little bit behind the curve as far as that's concerned. So I'm surprised it's taken us this long to get there. Not really a big impact on business, in the sense that it won't create an additional cost, but you may now have to pay VAT when you clear low value goods if you are in fact going down that and not buying them locally. And then, the last amendment that is significant but doesn't really have, sort of any impact on business whatsoever. And this is in relation to schools specifically, where schools are always part of the VAT net or potentially part of the VAT net. And there were a number of schools that did in fact register as VAT vendors and then claimed the input tax back on school halls and astroturfs, etc. If schools have now effectively been written out of the VAT net, so if you're registered under the South African Schools Act, you can no longer be conducting an enterprise. You're not entitled to register whatsoever. This comes into effect from the 1st of January 2026. What is interesting, though, is that there is obviously the exit VAT charge that's applicable in terms of Section 8.2. That schools would now have to fund. That only becomes due and payable in installments from the 1st of January 2027. So there's a year grace period to manage the cash flow. There's a little bit of a dispute in the industry as to whether this is going to have a big impact on school fees or not. I think the jury's out as far as that's concerned. SARS thinks the impact is very small. I expect the schools think the impact is in fact quite big in the circumstances. It's a little bit of an unfortunate development. I think the VAT Act is predicated on the supplies of goods and services, and when you supply the same goods and services, then the VAT consequence should be the same. And now what we've done is we've just taken a category of vendors and written them out of the VAT Act. So the development of the VAT Act, I think, is problematic as far as that's concerned. But that's Christelle, pretty much a high level summary of what's happened in the VAT space in the bill.
Thanks, Jules. I think the VAT, SARS and National Treasury just keeping up with how fast things change in the economy and in the world. So I think the saying leaving the best for last is probably not appropriate for what we left for last today in this webinar. I'm going to hand over to Simon to take us through the amendment regarding the bona fide inadvertent error and also just quickly touch on the changes to 11.4 and 11.5 related to High Court disputes. Simon?
Thanks, Christel, and good afternoon, everyone. So yeah, the USP regime currently works, how it works currently is, of course, that SARS can impose an understatement penalty if there is an understatement. And that is a defined concept that essentially means there must be prejudice to SARS or the fiscus as a result of, for instance, an incorrect statement by a taxpayer in a return. But crucially, in terms of the current provisions, even if there is an understatement, SARS cannot impose an understatement penalty if that results from a bona fide inadvertent error. So the concept of a bona fide inadvertent error is then typically used as an additional defense by taxpayers when SARS imposes an understatement penalty. And that defense, well, I guess, at least in principle, then cuts across the behaviors in Section 223 of the Tax Administration Act. So what this means practically, for instance, is that whether SARS imposes a penalty of 10% based on a substantial understatement, 25% on the basis of no reasonable care taken in completing a tax return, or 50% on the basis of no reasonable grounds for tax position taken, and so forth, a bona fide inadvertent error then serves as a complete defense that, if it's proven to exist, takes you out of the penalty regime altogether. And I guess you could say that the taxpayers and SARS have been at odds regarding the meaning and scope of this term, and the dispute there principally centered around what qualifies as a bona fide inadvertent error and what does not. So SARS generally held the view, and perhaps still does hold the view, that it only refers to unthinking mistakes or involuntary errors. So making a typo in a tax return, so more your clerical type mistakes. So evidently, and in practice, they adopt a very narrow interpretation of what constitutes a bona fide inadvertent error. The Supreme Court of Appeal, of course, in the Thistle Trust case and later in Coronation, confirmed that the concept is broader than SARS's approach. If a taxpayer makes a mistake while acting in good faith and acting without the intention to deceive, then an understatement penalty should not be imposed because that mistake would be a bona fide inadvertent error. In both these cases, the taxpayers relied on legal opinions to support their tax positions, and the SCA then found that understatement penalties should not have been imposed in the circumstances. The difficulty with these judgments, of course, is that the Constitutional Court on Appeal found in Coronation's favor, so the question of understatement penalties did not arise there. And the Constitutional Court declined to adjudicate SARS's cross appeal on the meaning of the term, and then instead remitted the understatement penalties on a different basis. So the National Treasury has now said that the prevailing contention on the scope and of what is a bona fide inadvertent error adversely affects the effective application of the penalty regime. And for that reason, the proposal will clarify the scope and application of the term by explicitly linking it with a substantial understatement which does not consider the taxpayer's behavior, but entails an objective calculation. So they're saying it's clarificatory, but it is quite a significant change. And then on whether it is an objective calculation, I guess that is correct, yes, because a substantial understatement exists if the prejudice to SARS or the fiscus exceeds the greater of 5% of the tax properly chargeable, or 1 million rand. So it is a sort of formula that does not consider the applicable behavior by the taxpayer, and it is also the lowest possible understatement penalty that can be imposed in terms of the regime. So what this means practically is that once this amendment becomes effective, a bona fide and inadvertent error will only serve as a defense if SARS imposes a 10% penalty on the basis of a substantial understatement. but it will not, for instance, serve as a defense where SARS imposes a 50% penalty on the basis of no reasonable grounds for the tax position taken by the taxpayer, which also happens to be, at least in my experience, the behavior that SARS most readily invokes. So the proposed amendment really does narrow the scope of this possible defense. And then, as I said, makes it only applicable where SARS has imposed a penalty of 10%. So, Christel, you mentioned earlier the importance of public participation, and there were quite significant comments made, I can see, from the response document on this proposal. But unfortunately, National Treasury just dismissed basically all of those comments. And they maintain that the amendment is necessary to facilitate what they call the proper functioning of the regime. And interestingly, they also say that it does not undermine, in their words, whatever clarity the Thistle and Coronation judgments gave on the meaning and the scope of the term. They also said specifically that the proper functioning of the regime is undermined because currently the lines between what is a bona fide error and what is a reasonable error have been blurred. And it was never the intention that a bona fide error should excuse culpable behavior, such as not taking reasonable care in completing a return. So I think based certainly on these statements in the response document, I think it can be safely assumed that the amendment is actually motivated by the SCA's judgments in Thistle and Coronation, which, as I said, ascribed a wider scope to the term than SARS's historic interpretation, which is of course much narrower. So I think the real test will be how SARS interprets and applies this new regime going forward, especially I think where tax position is based on professional tax advice. What is clear, I think, at least in my view, is that it doesn't diminish the usefulness of a proper tax opinion and tax advice. I think arguably it even heightens the necessity of professional tax advice and proper tax return reviews, because obviously the amendment will make it more difficult to ward off penalties of this kind. Like I said, while the amendment doesn't eliminate the offence completely, it does narrow its application quite significantly. So then just the last point on this, on the effective date, the proposed amendment will become effective when once the bill or the act is promulgated. So I think that the question here is then whether it will apply to understatement penalties that are raised after the effective date, which seems, I guess, a little bit arbitrary, or whether it will apply only to understatements that factually happen or occur after that date of promulgation. Maybe a bit nuanced, but I think that one could probably argue both those positions. So that's something that remains to be seen. So yeah, I think that's all from me, Christel, on the understatement penalties. The amendment to Section 11.4, just very briefly. So if you want to institute proceedings against SARS in the High Court, you're required to send a notice before you institute those proceedings. The proposed amendment is to allow the Commissioner or SARS to prescribe the information that needs to be contained in that letter.
Thanks, Simon. Yeah, some food for thought there at the end, and we'll just see how this plays out. I think we are on the dot for 1 o'clock, and I just want to thank everybody that dialed into this webinar today. Hope to see you all personally and in person soon. And then to all my fellow colleagues and speakers today, thank you for your presentation. And I mean, if there's anything that sparked a question in your mind, but you haven't asked in the Q&A, I'm sure you know most of us, you can just reach out to us and then we can have a conversation. Thank you, everybody, and have a great day.